Hi there, I'm Irk, and this is my channel, Get Irked. In this episode, is gold still the best way to protect yourself against inflation and world war, or is this yellow metal just a dead asset? Whether you're a huge gold bug or you're just a new investor, chances are you've heard of gold. And regardless of whether or not you have personal opinions on the matter, the question of whether or not gold still serves the purposes it was originally intended for remains on the table. In this episode, we're going to take a look at the three ways that investors have traditionally used gold over the years: as an inflation hedge, as a store of value, and as a safe haven investment. With the rise of Bitcoin and other cryptocurrency, you may have heard that a lot of people refer to gold as being dead, suggesting that Bitcoin is replacing gold as a digital gold instead of having the physical metal still retain the purposes that it's had over the years. Because of this, for me, I feel like investors would be better served owning a little bit of both of them instead of not owning either of them or just owning one of them instead. I think it's better to spread your assets across a diversified platform and make sure that you have exposure to different asset classes, even if you don't believe in them the same way as other people do. Let's cover a history of gold in an incredibly brief way. Gold was considered valuable because of its scarcity. Since it was hard to find, old civilizations found it to be valuable because of that scarcity. In the modern era, gold's value is derived both from its scarcity but also for its use in electronics. However, because of its extremely high cost, gold is often not used in electronics as much as other metals that also have similar but not as effective conductive properties. Up until 1971, when President Richard Nixon got rid of the gold standard, the United States currency, the US dollar, was actually backed by gold. To be backed by gold, it means that you could have taken each dollar that you owned into a bank and exchanged that dollar for the equivalent asset of gold. However, in 1971, by removing the US dollar from the gold standard, Nixon successfully converted the US dollar from being backed by gold to being what's called a fiat currency. The word fiat means an arbitrary or authoritative order, but a lot of people also look at it in terms of describing currency as being faith-based. With no real asset backing up the US dollar, the euro, or the Chinese yen, you have to trust the economy that's backing the dollar itself. And lately, with governments printing money like it's going out of style, the value of those dollars or yen or euros is dropping extremely fast, because the more dollars that are printed, the less value each individual dollar holds. The problem with a fiat currency is that a country who overspends or prints too much money can seriously damage its economy and devalue the currency. Because gold's scarcity remains relatively constant, the idea is that gold's value will increase in relation to the currency that you're talking about, so that buying gold would be able to protect your buying power, because as the inflation occurs in your fiat currency, gold's value would rise to match the buying power in the future. Opponents to gold will argue that it no longer serves as a hedge against inflation, because if you look at it on a year-over-year basis, it hasn't actually increased in value that much. And when you're talking about the CPI values that we've seen over the last year, we have inflation that we haven't seen in the past 40 years. However, it's important to remember that markets are forward-thinking instruments. In other words, they predict the future, not the present. When you zoom out and you view gold on a monthly chart, you can see that it does take into account inflation, having increased significantly in the last 22 years. It's also important to remember that you're not investing in gold. You're using gold as an insurance policy against inflation, so the returns that you should expect from buying the precious metal are not the same as what you should expect if you were buying the S&P 500. The second main use investors have for gold is as a safe haven asset. A safe haven asset is something that you would invest in if there's a geopolitical concern, or there's something on the horizon, or you don't trust your government. During these circumstances, main investment assets like the stock market will sell off dramatically, and for people who don't want to be in their nation's currency, one of the main alternatives is to go into gold. In this daily chart of gold, you can see what happens to the price of gold shortly after Russia started raising its heightened tensions against Ukraine. As you can see, gold can increase in value dramatically depending on what's going on in the geopolitical stage. So in this particular use case, it's still quite evident that gold is acting as a safe haven, with many investors moving into gold because of the disconcerting nature nature of what's going on in the globe right now. This brings us to the third reason that many investors use gold, and that's as a store of value. Because gold is typically less volatile than investment classes or even currencies, a lot of investors will store their unused currency as gold in order to protect its value over time. By keeping your cash in gold, it adds the benefit of not having to be concerned about whether or not your country is devaluing your currency or whether there's going to be a situation where you won't be able to get your money out of your bank because of a bank run or a bank holiday. Of course, if you're not holding the physical metal in a place where you can get to it easily, that's kind of an irrelevant fact. For example, if you put precious metals inside a bank account safety deposit box and the bank's on holiday, you're not going to be able to access the gold. There are three main ways that you can buy gold. The first is to buy it from a local gold dealer or to buy it from an online gold dealer. The best kind of gold to buy is the one that is native to your country or one that is from a major mint, like the ones in the United States, Canada, or Australia. And it's important to remember that when you're buying the physical gold, you will not be paying the spot price. There's a premium above the spot price because of the labor, time, and effort that it takes to make physical gold into bars or coins. That premium changes over time depending on how popular gold is. For example, the filming of this video, a good premium that you can find online is about 4.75% if you pay in cash. If you pay using a credit card or another form of payment, you'll find that the premium increases, sometimes substantially. Right now, premium for a credit card purchase when you're not buying in bulk is over 9%. I watch a lot of YouTubers who talk about using gold as a savings account. They'll go out and buy physical gold and then keep it in a safe instead of spending that money or having that money in a regular savings account. Personally, I only use physical gold as a hedge against potentially high inflation. I do not use it as a savings account. Since gold's price can remain stable for long periods of time, it means that you're also subject to inflation combined with the premium. So even if gold's the same price now as it was last January, the premium cost of 4.7% means that you're actually taking a hit, even though the dollar amount is the same. Because of the inflation combined with the premium, you're actually down if you'd bought gold instead of just holding that money in a savings account. Because a high interest savings account, while it's still not earning much, still earns you 0.5%, which is more than you get from gold. There's no yield in gold. In fact, if I was going to hold gold as a savings account, I wouldn't actually buy the physical metal. Instead, I would invest in it using the ETFs GLD or IAU, which are two ETFs that supposedly track the spot price of gold. Since there are no commissions when it comes to stock trading, you could actually buy in and sell out of the ETFs without paying any premium at all. Now, a lot of gold bugs will tell you that the price of gold is manipulated by the open market. However, that manipulation is going to affect you whether you own the physical asset or through GLD or IAU. However, as a hedge against inflation or political uncertainty, I would not use the ETFs. I would buy the precious metals for those purposes, and that's why I hold physical bullion myself. For me, I like having exposure to gold in my investment accounts as well, so that when there are times of political strife, I'll have an asset that's increasing in value even if the entire stock market is selling off dramatically, as we've been seeing since the beginning of 2022. However, instead of exposing my investment accounts to IAU or GLD, the spot ETF trackers, I actually buy the gold mining stocks instead. The cost of a gold miner stock increases much faster when the price of gold goes up. However, it's important to remember that the price of a gold miner stock will also decrease faster than the price of gold is decreasing. There are a number of ways that you can invest in gold miners. You can buy the gold miners themselves by buying senior gold miners like Barrick Gold, ticker symbol GOLD, or Newmont Mining, ticker symbol NEM. And you can also buy the smaller gold miners, which are a lot more risky but could have a lot more upside, like Equinox, which is ticker symbol EQX. In order to reduce risk, another alternative to buying the gold mining stocks is to use the ETFs GDX and GDXJ. GDX tracks the senior gold miners and GDXJ tracks the junior gold miners. Additionally, one of the benefits of buying the gold miner stocks instead of just the gold ETFs is that they do have a yield. Many gold miners provide dividends every year. The Junior Goldminers ETF from Van Eck, GDXJ, has a dividend yield of 1.84%, whereas the best in breed in the space, Barrick Gold, has a yield of 1.65%, and another excellent gold miner, Newmont Mining, provides a yield of 2 2.96%. However, it's important to remember holding the stocks of individual gold miners does carry a lot more risk than holding the ETF. If something horrible happens to Newmont or Barrick Gold, their stock price will drop dramatically. And while any negative news story will affect GDX and GDXJ, because they hold different stocks in all the different gold miners that are available, the ETF will be balanced out, and the chances that an ETF can go completely to zero are extremely slim. Huge proponents of gold will tell you to buy as much gold as you possibly can, but for me, I like to have a diversified portfolio and balance it out. In my stock portfolios, I don't hold more than 5 to 10% exposure to gold, and when it comes to holding the physical metal, I have to put it in safes or vaults, so I have to be careful and think about how much it costs to store it. So in that case as well, I never have more than 5% of my net worth in the bullion, and I do not keep it on premises. For me, gold is one of those asset classes like Bitcoin or cryptocurrency that I want to have some exposure to. I never go all in on any investment, and I would never do so when it comes to precious metals or crypto. However, I do think that every investor should look at their own investments and figure out how they're going to protect against geopolitical concerns or inflation over time. To learn more, visit my website, getirk.com, which is always 100% free. Check out my other videos. Please hit like and subscribe, and I'll see you in the next video.